Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Giulietta.
Garth, we've actually had a 2-week hiatus, a couple of shows that were pre-recorded, but you're back from your holidays, and you're going to start off by talking about the S&P 500, which is rampant at the moment, shows no sign of slowing down.
It is indeed. A few weeks back, we said that once it had pushed out through that 28.15 resistance level, then it looked like it was going to move on and go and retest the prior highs, which were set in September last year. And that level is at 29.40, and we've now traded up to that level and been bumbling around there. It looks to me like we probably will possibly punch through that level as well. And if you look at this is a weekly chart of the S&P 500. It shows now the extent of this rally that we've seen off the December lows after that very bearish fourth quarter of last year. I mean, the V-shaped recovery here has been absolutely remarkable. And as I said, we're testing the prior highs now and looking as if we might continue to push a little bit higher. I think if we do, there's a fairly good chance we go to 3,000 on the S&P 500. And that's kind of where, if I join those prior tops, that's where that level comes in. So there would be a bit of resistance there. And I wouldn't be too surprised if we get something similar to what happened in that rally last year, where it goes, it briefly takes out the prior high, and then it does, it stalls at that point. So I think if it does get up to 3,000 or just a little bit above 3,000, I'd probably start to get fairly cautious up there. But for the immediate future, it does look as if it might still have the wind in its sails.
Yeah, I mean, and our own markets, the start of the week, of this week, wasn't great. We pulled back a little bit, but we're quite resilient, notwithstanding.
We are resilient. I mean, this is our top 40 index, the spot index now, and you can see it's still very much inside that channel that's been intact since December of last year. That's defined the trading boundaries very clearly. It bumped up against just above 53,000 and seems to have been pulling back a little bit from there now, which is fine. I mean, it's not unexpected that it would consolidate a little bit after bumping up against the top of that channel boundary. But overall, that chart structure is still bullish for now. It's still making higher lows and higher highs. Yeah. It's had a strong rally since the latter part of March. I mean, you can see there we've put on about 4,000, just over 4,000 points in a month. So it's been quite a big move to the upside, and it's not surprising now to see it consolidating a little bit.
Yeah, and that in itself has been quite interesting because the first quarter was so good. Maybe a lot of people thought, okay, well, we've had the gains, but it actually kept pushing on higher. So
yeah, it has. Our market's been pretty solid this year, but that's in line again with overseas markets as well. Everything's been climbing since those December lows of last year.
Yeah. Well, now let's get on to, before we talk forward-looking for the markets, what about the two recent trades that you enacted for the portfolio? It was Google and Verizon. Yeah. Google is interesting because it was doing really well and it came out with, well, the parent company Alphabet came out with results on last night. Yeah. And the stock got smacked. So where are you at?
Well, yeah, it will get smacked. It's currently being smacked in the after hours or out of hours trading. So here we are, right? This is the chart of Google, and we put this trade on at the end of March, moving into the early part of April. I like the fact that it was in that rising channel, very bullish chart setup with higher lows and higher highs. Also, the tech sector has really been what's mainly been leading the US markets higher. So obviously Google falls into that space. There was this falling wedge pattern, which is typically a bullish continuation pattern in a rising trend. And when it began to break out of the upper end of that wedge pattern, that was the signal to go long. So we bought 10 CFDs for our portfolio at $1,183 per share, with a stop loss at $1,160 and a target of $1,230 a share. Now, it's moved up, and what I said at the time was that I would probably look to take half the profit at our target and then try and run the profit. And I've said a few times this year, this is something I want to try and work on, is actually trying to extract more out of our winning trades. Because by doing that, it really does enhance your risk to reward ratio if you can run your winners. And the saying goes, run your winners and cut your losers quickly. So I was doing well here. And my plan was, with the remaining half of that trade that we still held, was to basically run a trailing stop loss below the prior day's low. So if the share price closed below the prior day's low, then I would look to exit. Okay. And it hasn't closed below the prior day low at all since we've been holding it, since certainly over the last couple of weeks. So it's been looking great. And however, as you said, in after hours trade, Alphabet's come out with numbers which are disappointing. And the share's trading down by about 7% in after hours trade. So it's not reflected on this chart because this chart doesn't It only shows the trade up until last night. So that means that when it opens today, it's probably going to trade all the way back down to about $1,200. So it means that a lot of our mark-to-market profits that we have on the remaining 5 CFDs is going to evaporate. We did make $233 on the ones that I sold, but the ones that I haven't sold were looking great, and we're going to get a bit clobbered when it opens. But anyway, it is what it is. It's frustrating, however.
Yeah, because on the one hand you say, okay, you've got to learn how to run the winners, and you were doing that, and it was all working out absolutely perfectly, banking half the position. Now what? I mean, is it maybe a case that in hindsight, okay, hindsight is a perfect science, but around results, should you actually maybe kind of cash in a position before results are released? Because either way, because unfortunately you might, if Alphabet's results had beaten the market, it might have gone up 7%.
Yeah, that's right. So I think you're right. The lesson here, I think, is to probably not be exposed around results time. And it's something I know because the way US stocks trade following results is quite remarkable. You often see these enormous gaps either up or down, but it's a risky time to be holding a position around results. So I think the lesson here is something that I kind of have read about and I should know already, and maybe this is just a reminder of that fact. Don't be exposed around results time because there's just a whole lot of extra risk that you don't really want to be involved with.
Yeah, okay, well let's see how that pans out further. And then what about Verizon? So this hasn't worked out at all, it looks.
No, it hasn't. So we put this trade on just before I went away. And what I liked about it at the time was that it was also looking bullish. The stock was making higher lows and higher highs. It had broken out through this overhead resistance zone, which is at about $57, $58. It rallied, it had pulled back, and it was clearly finding support around that area where the prior breakout had occurred. You had multiple levels of support there at about $58 a share, with the uptrend coming in and the prior highs, which were then support. So, and all the daily candlestick patterns were forming long tails to the downside, which generally indicates that there is buying at the lower level. So to me, it ticked a whole bunch of boxes for a long trade, and that's why we did go long. So we bought 205 CFDs at $58.60. With a stop loss at $57.50. And I was looking for a target basically for it to move back up to its prior high at around about $61. Now, as you can see, that has not happened. The share price broke down, it broke that uptrend, and it broke down below the lateral support area as well.
Quite viciously too.
Quite viciously, yeah. Now, because I was away, this was one of the occasions where I actually did use an automated stop loss. You know that I often prefer to manage my stop losses manually, because I do watch the screens. But in a case where you're not around to watch the screens, it's important to put an auto stop loss in. So I did, and in this case, it stopped us out at that exact level at $57.50. It meant that we lost $227 on the trade.
So what you gained on Google, you've lost on Verizon.
Yeah, exactly. It's very much a case of one step forward, one step backwards at the moment, because exactly the amount we were made on the Google trade, we've pretty much given all of that back on Verizon now. So I guess it's better than going backwards, but it would be nice to take a few consecutive steps forward. It
would be. Someone's going to have to stand you dinner or drinks at the bar at the moment.
Yeah.
So that is unfortunate. All right. Well, let's move on to the local market, because this is, I think, going to be quite. I don't think anyone knows what to do at this point. Yeah. I certainly get, last night on Stockwatch we were talking about whether or not we just stay in cash ahead of the elections, because is there going to be a big swing either way?
Yeah, the election is obviously it's in massive focus at the moment, and this is the most important election that we've had since 1994. And the real focus of the market is really going to be around the ANC's majority, assuming they get a majority in this election. That's what the market's looking for. And the greater their majority, I think that'll be a good vote in Cyril Ramaphosa's favor, which the market would then take favorably. So that's kind of what the market's looking for. I think that is really the critical thing, and that's why I'm focusing here with this slide specifically on the outcome of the ANC's result, because the smaller parties, the opposition parties, I think are of less significance right now. It's really how the ANC fares that the markets are most closely following. So those are the scenarios as I see it, and that's from everything I've read, and there's of course, multitudes of stuff out there on the internet and in the media.
Yeah, and points of view, certainly.
And points of view and polls and different results and all sorts of things. But broadly speaking, those are sort of my scenarios. I think that the base case is probably that the ANC comes out somewhere between 53 and 58%. Anything less than that, 52% or less, would probably be quite a bearish result.
Which is quite interesting, given that this is the party which is the face of corruption in South Africa. So to talk about punishment at the polls being regarded as negative is really weird.
It is weird, but I think what we've also got is, for once, we've actually got a leader in Cyril Ramaphosa who is desperately trying to make the right moves for the economy, to try and stamp out corruption, etc., etc. And obviously he's been walking a very delicate tightrope within the ANC. But if the ANC comes out with a strong majority in this election, then the follow-on from that is that it's a thumbs up for Cyril Ramaphosa, and it effectively gives him the mandate to then proceed further with his anti-corruption mandate and his growth mandate. So the markets would probably deem that to be a positive thing. So that's why I say 58% or more would be the bullish outcome. Now, we don't know. I mean, obviously, I think my base case is somewhere between the neutral outcome and possibly up to the bullish outcome. But we know that there's polls out there. I mean, today, the Institute for Race Relations have released a poll that suggests there's a possibility that the ANC might get less than 50%. Who knows?
It is a small sample, 2,000. I'm not sure about that.
It's a small sample, so that's why I'm not so sure about it. But of course, it is making headlines.
But so how does one position themselves, Garth, in the last couple of minutes of this show?
So, I'll look at each of the scenarios. The bearish case, 52% or less for the ANC, I think what that means is that the rand would likely weaken. We'd probably see it moving to 15 rand to the dollar, or possibly a bit weaker. Bond yields would rise in that case. Your domestic South Africa incorporated stocks would suffer. Dual-listed rand hedge stocks, the likes of British American Tobacco, Naspers, Richemont, BHP Group, etc., the ones that are dual-listed, those would probably benefit from a weaker rand. And then your listed property would suffer in line with a weaker bond market.
Yeah, neutral?
Neutral, which is more my base case, the rand probably moves moderately firmer, probably towards 14 rand or maybe a little bit below 14 to the dollar. Bond yields move lower in that case, which is bullish move for bonds. Your domestic stocks, your South Africa Inc. stocks would likely be firmer in that scenario. Dual-listed rand hedge stocks would probably lag a little bit because of the strength of the rand, and you'd find that listed property would move modestly higher in line with a firmer bond market.
And then bullish?
Right, and in the bullish scenario, if the ANC were to get more than 58%, then the rand moves sharply firmer, possibly heading towards 13 rand 50 to the dollar over time. Bond yields would also move sharply higher. Your South Africa Inc. stocks, so your domestics, retailers, banks, financials and the like, would probably be strong in that environment. Your dual-listed rand hedge stocks would lag because of the firmer rand, and your listed property shares would move higher in line with a stronger bond market.
Yeah, so very interesting, and I suppose maybe the safest option is to be in cash.
Possibly.
Yeah. Garth, very quickly to wrap up, let's have a quick look at the portfolios.
All right, so our South African portfolio is up a little bit from when I was last year. It's up 6.4% for the year to date. We still do have a position in CUP Industrial there, which we're getting a bit tired, but we're still in that. And then offshore, we've up 2.2% for the year to date. Obviously, that's going to change when Google opens today. We're actually going to probably wipe out most of our gains for the year to date on that portfolio, which is a pity. Yeah, indeed. Well, we'll leave it there, and we'll be back next week, the Tuesday before the elections, and hopefully see how it plays out the Tuesday after. Garth, thanks as always for joining us. Garth McKenzie is, of course, founder and editor of Traders Corner.